So in September 2022, the Fed began operating at a loss. Again, covered this in the article, and we'll make sure that it appears in the show notes. People really should read it. Was this the first time it happened, and why did it happen?
So this is the first time in modern history.
Wow.
There are some similarities back in, say, the 40s or so, but it's certainly in modern history. This is the first time it happened, and the reason it happened is because we've had like 40 years of declining interest rates, and so there's never a time where they sharply raise interest rates so much that their liabilities are yielding a higher interest rate than their existing assets. Whereas in
Right.
2022, they raised interest rates so quickly that the interest that they're paying on their bank reserves and interest rates that they're paying on reverse repos are higher than the average interest rate that they're earning on their treasuries and their mortgage-backed securities. And so the Fed now has an operating loss instead of an operating income. And so they're now basically, if they were a normal bank, they'd be on the verge of insolvency.
Yeah.
But because they're a central bank, they're different.
When the Fed started raising rates, everyone said that this might be a reason that they couldn't raise them for too long. Clearly, that's not paid out. So why are they willing to go into negative equity to raise rates? Sorry, why are they willing to raise rates so high that they put themselves into negative equity?
One reason is because of the way the accounting's set up, they don't get kind of near-term consequences for having negative equity. And so the way that Federal Reserve accounting works, so right now they're operating a loss. They're no longer sending money to the Treasury because they're not making money to send it to. But then what they're essentially doing is they're eating into their equity. But instead of actually market to market and saying, okay, now we're actually approaching negative equity, they give themselves an asset. It's called basically it's a deferred asset, so that in the future, if they're ever profitable again, they get to pay themselves back first. They get to dig themselves out of this hole before they would resume having to give their excess profits back to the Treasury. And so it's kind of like if you had a business and it starts to go bankrupt, and you say, well, in the future there'll probably be a time when I'm not bankrupt, and so you basically borrow from the future, from my future self to pay back when that happens. That's kind of the thing that the Fed's doing, where they're approaching negative tangible equity, but unlike a normal bank, there's no consequences when they hit zero. There's no consequences immediately, at least when they go negative. And so the main difference is just that they can continue operating, and it's actually the main consequences are for the Treasury. The Treasury now has lost a $100 billion income source.
Yeah.
And even in the future, when the Federal Reserve is profitable again, if they're profitable again, it would be a long time before that income source is recovered, because the Federal Reserve would be not sending remittances to the Treasury because it would be digging itself out of its prior hole before it would ever begin sending more money to the Treasury. So basically, the Federal Reserve is able to do it because the consequences are, for the most part, not on them. They're on the Treasury, they're on the taxpayer, rather than them. Now, if it goes on long enough and kind of to a significant enough degree, you could start raising questions around central bank independence, right? Because if you're technically insolvent, that starts getting that's a different scenario, but that's a long way off. In this sort of intermediate phase, they have virtually zero consequences for this, and the consequences are instead on the Treasury.
So this current situation, is it getting worse? And like, how dire is it?
So it is getting worse. It's probably going to continue for a long time. It's not as dire. So the reason I wrote this article is because a number of weeks and months ago, I started to see basically these doom charts, especially because the St. Louis Fed charting system is kind of broken for this particular metric, and so it looks really bad. And so there are a lot of people sharing that on Twitter. So I actually was inspired to make an article to say, okay, what is behind this crazy chart that I see being shared around? So the short version is there's nothing going to explode because of this, right? There's no near-term or even intermediate-term like wall that they run into for doing this. Instead, the main couple consequences. One consequence is that budget deficits are going to be bigger now, because that $100 billion income source just completely vanished and is not coming back anytime soon, most likely. So that's like equivalent to 4 NASA's worth of expenditure, right? So these days, $100 billion seems like nothing to people, but
Not me.
NASA, for example, is like 25 billion. So the U.S. government lost an income source. That's one tangible consequence from this. On the other side of that, the commercial banking system is basically getting paid pretty well because of this, because all that negative equity is basically draining out of the Fed and going into the commercial banking system. So they're actually making out pretty well. Those liabilities, those higher liabilities from the Fed, those higher yielding liabilities, I should say, that's paying out to banks. So banks are basically getting paid to do nothing. So they don't mind the situation. And the longer term potential consequence is you'll get someone like Senator Warren or others either complain that the Federal Reserve is paying banks too much, or you'll get people started to say like, hey, why do you have this much negative tangible equity? Doesn't that threaten your central bank independence? And so some of the long-term consequences can build up by starting to politicize even more so what some of the Fed actions already are.
And so if the government have lost that income stream, or the Treasury has lost that income stream, is there anything they can do?
The short answer is no. They could cut expenditures, but they're not going to. So instead, essentially what they do is they'll issue an extra $100 billion worth of Treasury securities. And so the debt will rise more quickly than it otherwise would have if this didn't happen. And that's, of course, compounded by the fact that these higher interest rates on the debt are also causing more debt. And so, for example, if they had $400 billion in interest expense, at a lower interest rate environment, they now have like $800 billion in annual interest expense at this higher rate environment. It could go higher than that. And that's now, they're not cutting something to pay for that. Instead, they're just issuing more bonds than they otherwise would in order to cover that. So they're basically increasing their debt load in order to cover up the fact that their interest on their debt is higher and they just lost an income source. So it kind of just builds up over time.
Yeah, it feels like a precarious position because if we look at those layers, the likes of us, we're lending money at a very low interest rate to the banks. They're using that to try and generate an income, but they're using the Federal Reserve or the other central banks as essentially their bank. But they're all operating at a loss. So essentially these central banks, which underpin all money in the global financial system, are kind of insolvent. It doesn't feel like it feels very precarious.
Pretty much, and I think that manifests generally through inflation.
Right.
One thing I like to highlight is that it's very different than 2008. 2008, banks were at risk due to basically deflationary collapse. There's way more claims than there were base money. And so it was a risk of all falling apart. Now, instead, I think the key risk is longer term inflation. Doesn't mean you can't temporarily get the inflation rate down, but it means that as long as these forces exist, the inflation rate's bias is up. And so unless it's actively being held down, it's ready to kind of keep popping up or kind of keep being a problem. And one way to think about it is kind of like how everything's a nested ledger, right? So we have accounts at banks, they have accounts at central banks, and central banks back up their assets with like government bonds. Bailouts kind of happen upward as well. So for example, when in the 90s, you had long-term capital management, a big giant levered hedge fund that blew up. The Fed had it bailed out. That kind of contributed to the dot-com bubble happening. That all blew up. Then they cut interest rates, and then we had this big housing bubble. And when that kind of finally struck, basically the private sector was totally out of ammo. The whole thing, the whole Ponzi was kind of being like started to get mark to market. They basically pulled private sector leverage onto the public sector balance sheet. And so it all kind of wound up on either the Federal Reserve in some cases, or it wound up just right in government deficits and debt. And what we're seeing now is that when all that is held up to the sovereign level, when you have all the debt goes up very high, the only place to kind of release it from there is onto the currency, right? So you get ongoing currency devaluation, ongoing off and on inflation, and ongoing periods of time where however high or low yields are, they're spending most of the time below the prevailing inflation rate, and therefore savers, bondholders all these types of holders in the system are essentially getting devalued. And that's kind of just spreading out the losses to anyone who's involved in the currency.
And this is kind of like when you said to me on our last couple of interviews, you said the story of the next decade, you said, is probably going to be inflation. And I guess this is why.
It's a key factor, yes. I think that what's going to drive inflation over the next decade is a combination of uncontrolled fiscal deficits by most of the developed countries. And then two, unlike the past decade, there's not really like a buffer for commodities. So there's no real like commodity oversupply and deflationary commodity markets that can offset some of this. So you have the combination of money creation's happening because deficits are high. One way to think of it is that government deficits are a surplus for the private sector. So it's basically it's a way that money kind of pours into the system. And then when you also have tight commodity markets, that makes it so that those increases in money supply do translate into higher consumer prices pretty readily. And that's also true for things like labor shortages. Now, you can have periods of time where, if you get a recession, if they cause a big enough contraction in a period of time, you can get a temporary disinflation. You can get a temporary, contraction. You can reduce demand enough to maybe suppress prices for a period of time. But I think those are going to be, the cyclical things, whereas the structural thing is that inflation, unless, of course, they find a way to sharply reduce deficits, which is, at this stage of the crisis, very, very hard to do.
So in the article, you compare what's happening now with the redeemability of gold in 1933. Can you tell that story? I'd never heard that, and the end of that story blew my mind. I did not know this happened.
Yeah, so I'll tell it in two parts. One is people often ask, why can't a government why can't a central bank just forgive the debt it owns to its government? Like if the Federal Reserve owns a lot of treasuries, why can't there just be a debt jubilee and the Federal Reserve just forgives that portion of the debt because, it's owned by the central bank? Who cares? And the reason is if they did that, the asset side of their balance sheet would be deleted and they'd still have all the liabilities, right? So they would now have basically no interest income and no assets backing up their liabilities. And yet they'd have all these liabilities. So they would lose their independence. They would rely on funding by the government, and you would not have independent central banking anymore, right? So that's one reason why they can't happen. And so they actually faced a similar thing back in the 30s, which was, back then, the Federal Reserve owned gold, and basically, the liabilities, the monetary base represented claims for gold. You could take your dollar and you can get gold with it at a fixed rate. But because you had a massive banking failure, they wanted to increase the monetary base, but they couldn't increase the amount of gold in the system, and they wanted to centralize all the gold. Instead, they severed the redeemability for gold. They devalued the dollar relative to gold, but then they also said the Federal Reserve has to transfer all of its gold to the Treasury. But they couldn't just do that on its own because then the Federal Reserve would have all these liabilities and wouldn't have assets, right? So they instead said, okay, we're not just going to take your gold. We're going to take your gold, and then we're going to give you gold certificates that represent the fact that you still kind of own that gold.
Kind of.
But they're not redeemable. Yeah, exactly, kind of. So here's non-redeemable gold certificates. Kinda. And it's what is a non-redeemable gold certificate? It's
bullshit.
It doesn't make sense. It's just and what it is, it's an accounting gimmick. All it is saying that here's a placeholder asset that makes it so you're not insolvent, and that makes some degree of conceptual sense. We took your gold. Here's your claim for the gold. You just can't redeem it, and so that's what kept the Fed solvent for decades. Otherwise, without that gold certificate, that was really means nothing. They would be insolvent on paper because their liabilities would greatly exceed their assets because their assets, gold, were taken from them. And they actually still hold those today. They used to be a massive part of the balance sheet back when the balance sheet was measured in billions of dollars. But now that everything's so much bigger, those gold certificates they're holding from 90 years ago are something like $12 billion. I mean, they're tiny compared to the size of the Federal Reserve balance sheet today, but they're still holding these meme certificates 9 decades later. And these like accounting gimmicks that the Fed's using now, where when they lose money, they instead have these deferred assets. They're kind of the same sort of accounting gimmicks where they're approaching the period where they're insolvent in terms of tangible assets, but by having kind of these imaginary assets fill the gap, it's kind of like magic, and then they're not insolvent.
Lyn, how long can they go on like this for?
I think it depends on a lot of factors. It depends on what happens with commodity markets. It depends on what happens with trust in the system. Right now, for example, whenever you see inflation indicators go higher, usually the dollar strengthens because people say, well, the Fed's got to get tighter then. And so that they'll fix this inflation by getting even tighter. And so it actually strengthens the system. Now, I think when that breaks down is when they're basically so tight and there's still a problem. People say, well, they can't even get any tighter. And then they start essentially selling the system. So I think that the short end of it is that you can still go on quite a bit longer in a similar way that you can look at Argentina or Turkey right now and you can ask, why is this still going on? If you're having high double-digit, borderline 100% inflation, how is that still going on? And it's a couple of reasons. One is that they don't really there's no clear path to fix it in the countries. And two, they've avoided collapsing to the point of say a Lebanon or an outright failed state. They're kind of in that intermediate state where you're still you're still able to function in these countries, and just the money system is just broken, and just month after month, quarter after quarter, year after year, it's even more broken. I think you see a light version of that today in a lot of developed countries where it's kind of broken, but it's not broken so bad that it leads to an outcome next week, and so it just kind of keeps grinding on. And so I think that basically it's going to be a multi-year story of just inflation on average is going to be higher than the target level, and there's going to be various kind of reasons why that is, debates about why that is, what the Fed should do. There might be periods of time where they get it under control, often probably ironically because of a recession. And they say, well, I mean, we caused a recession and we got inflation down, and then you try to grow back out of that recession, and then you get inflation again. So it's almost like it can go longer because it's not a straight line and it's nowhere near hyperinflation. So you get that kind of long grind. And so I think it can go on until you start to get really, really negative tangible effects. And so, for example, one deadline is that by around the year 2035, Social Security goes bankrupt. And so what that would mean is that not that they have zero payouts, but that they can only pay out from incoming tax revenue, which is insufficient. And so you'd have to basically do a haircut for Social Security payouts, which would, of course, piss a lot of people off. And so in the run up to that, you'd have a big issue. Or alternatively, they could increase taxes, but then you'd get another group of people would be pissed off. And so there are these kind of deadlines where certain things literally run out. But in the next several years, it's just kind of this ongoing background problem that people live with in a similar but less extreme way than people live with it in Turkey, Argentina, and a lot of these other types of countries.
So I just want to make sure, by 2035, with current projections, Social Security goes bankrupt?
Yes.
Wow.
So the way it's been working is that basically they've had a surplus, and they store that in treasuries, actually. It's non-marketable treasuries. So they actually earn interest on their savings. And just actually right as last year, instead of that surplus going up, it's starting to roll over and go down. So now the program is so top heavy that they're paying out more than they're getting in, but they do have those savings to draw from. And so basically over the next, call it 12 years, and sometimes the estimate changes. They used to think it was going to be 2034 and then it's 2035. It's not big changes, but there's a slight amount of variance for exactly when this happens, but roughly around 2035, that it's about $3 trillion currently, that surplus that'll be drawn down. And then you have a situation where, you're already at this point, taxes are not covering the payouts, but there's no reserves to draw down either. And so you'd have to cut payouts or increase taxes, some sort of resolution to that outcome. And that's basically it's a somewhat different budget process than the rest of the fiscal budget.
We sound so fucked. Excuse my language, Lyn, but we sound so fucked.
I mean, I think the way this likely manifests over time is you get greater and greater political polarization.
Yep.
Greater and greater just differences in opinion on how to handle that, right? I mean, there's actually some people that are like, no, you have to raise taxes to keep paying for this stuff. Other people are going to say, no, you have to cut spending because taxes can't go any higher. And it comes down to like either checks are going to get sent or not. I mean, we have a smaller version of this every couple of years with the debt ceiling debate, which is what we have this year coming up. So that's kind of a nearer term version. But then the longer term version is that fiscal spiral that you have over 100% debt to GDP. You have interest on that debt. You have ongoing pretty large deficits, and you have real world constraints in terms of labor, in terms of commodities and things like that. And so basically the public ledger is broken. That generally manifests in inflation, and how high that inflation is partially depends on economic growth, commodity availability. Maybe we have gigantic productivity breakthroughs and we push this out longer, or maybe we have war and we pull it up sooner. Right? There's all these factors that can influence the timing and the magnitude of what happens. But essentially, when you have these structural massive deficits and high debts, it generally manifests in inflation grinding on over time until you have some sort of political consensus to figure out how to balance that out, which generally only happens after a lot of damage has been done and after a lot of those debts have been effectively inflated away.